All right, good evening. How are we doing? Great. Awesome. It's great to see a lot of familiar, smiling faces. Some of you we've seen lately in the office. Some of you it's been a little bit. But great to see a lot of familiar faces. One item I have on housekeeping. No talking about the Denver Nuggets score. Are we good with that? Okay. So I know a lot of you are recording it. So I don't want any cheers or any oh no or anything. All right. So no checking scores until you get out of here, and even if you do, be quiet because a lot of people want to go home and start from the beginning. Are we good with that one? Okay. And go Nuggets. All right. Okay. Yes, sir. It better be done by halftime. All right. So first of all, my name is Kyle Odell. I'm the CEO of Edrock Wealth Management. I appreciate everyone coming out tonight. So thank you very much. We're going to do our best to keep this at about an hour if we can. Okay, try and be respectful of your time. We have a lot of information to cover, and we're going to hit on about 10 different topics. And these topics, I mean, some of them we could take an hour or two on some of the topics. Okay, there's a lot to this area, so we're going to lightly hit on a lot of them. Going through, so I'm going to introduce our panel up here. So first of all, we have Courtney with Horn Funding Group. Courtney's in the mortgage industry. She's closed over 3,000 clients since 2001. FHA, VA, first-time homebuyers, jumbo, investor loans, everything. She has worked with several of our clients on some unique situations and done a fantastic job. And I really appreciate her showing up to bring her expertise to tonight. And I think she'll have a lot to add. And then we have Stephanie Dahl. So Stephanie is she's one of the managing partners and founders of Dahl Fisher. She's a Colorado native, active in the community, sits on multiple community boards and commissions. So as an estate attorney, she practices specifically with estate planning, probate and small business formation, small business and transactional work. Stephanie's also worked with some of our clients in here, and Stephanie's done a fantastic job. Lucky to have her tonight, and I think to bring a lot to the table also. And also, we have Laura and Chris Posey with Bender and Lang, so our two CPAs this evening. Bender and Lang has been around for more than 50 years. Chris and Laura have not been there for 50 years. Okay. So they provide tax and accounting services to thousands of clients, individuals, partnerships, C Corps, S Corps, trusts, estates. They also provide bookkeeping and payroll services as well as QuickBooks setup and so forth. And looking forward to having their expertise tonight. I think as CPAs, you're going to be talking on every slide. So there's a lot to throw in. So now a couple quick disclaimers. We're not giving any advice tonight. Are we good with that? Okay, that's more of a one-on-one conversation to sit down. As we're going through things, if you have a question, raise your hand. We'll try to get it answered. But the one thing I ask is please don't ask a personal question that would involve advice. If you wanted us to clarify something, ask that and so forth. We'll give you an opportunity afterwards on that form that you have. There's a QR code on the bottom where you'll be able to sign up for a quick conversation or an actual one-on-one appointment with one of us or maybe multiple of us or whatever that may be. We'll talk about that a little bit at the end. Are we good? Okay, and feel free to grab more water or food as we go through, and we'll get going. So, I've been in this industry now for, in the financial planning and industry where we, our specific firm, Edrock Wealth Management, we focus on wealth management and tax planning. And, in the 28 years I've been in this industry, I think this area here, in meeting with a lot of clients over the years and a lot of families, there's a big gap. And I think this is an area of, I think there's kind of a black hole here where there's not a lot of education understanding. You hop on YouTube and you can get 1,000 different opinions and all kinds of things on what to do. And so hopefully tonight we can clarify some of that. Our focus is always to go beyond the portfolio, which is where most advisors sit, is just on the portfolio side, but we take that into account along with how do we create income and get into tax planning and the estate side and so forth and look at everything. So we're going to dive in. Like I said, we've got a lot to cover. We're not giving you any advice tonight. Our panel, on that QR code, we'll talk about how to get in contact with each of them and so forth. So, like I said, lucky to have everyone up here tonight. So, owning real estate. What are some of the benefits? One would be appreciation. It depends on how far back you look, but properties in the U.S., appreciating, and Courtney, you may have some numbers on that end, but maybe 3-4% at different times in the market. Mortgage reduction. I think this is a big area here. I have clients come in all the time, and they'll, you may own a rental property, and you'll have questions about, Kyle, how do we pay this mortgage down? And my opinion has always been, well, let the renter pay that down, especially if you have a great interest rate. Don't take your own money and pay that down oftentimes, right? You have cheap money, especially today. If you refinanced or bought a property, in the last 10 years, you probably have a fantastic rate. Why would you accelerate that, especially if inflation's higher than that rate, right? Cash flow, that's a big one in the long run. Paying that property down, and then the tax deductions. Tax deductions, we'll get into some of that. The tax deduction that you can get with a property is not a reason to go buy a property, though, right? It's kind of icing on the cake. So, and as we go through each one of these slides, I've encouraged our panel up here to throw in their 2 cents or add different talking points, but anything to add? I know, Courtney, you're probably chomping at the bit to add in a few things, but anything to add?
Not at the moment, but I think we can definitely talk about from the mortgage perspective of how to utilize, like Kyle said, your money and utilize it to the best and cash flow that property, and different things that we can do on the mortgage side of things to really capitalize on the investment and maximize that. So we can talk all about it.
Yep, absolutely. And I kind of have a rule of thumb when I'm talking with clients and see if any of you have a number to throw in. But one of the things I talk to clients about, let's say you own a property that's a $500,000 property and you're collecting rent on that property. Kind of the rule of thumb I've always shot for is about 6% of that value. So 6% of 500,000 would be 30,000. If you have $30,000 of rent coming in on maybe a little higher than that or maybe a little less, but that's kind of the rule of thumb I've typically used when I've talked to clients, because when I sit down with a client and we talk through, okay, you own some rental properties, what are we charging on this property? And if we find out we're only charging maybe 4% of the value, well, maybe we're undercharging there. And so we want to a lot of times see if we can bring that up and get a little more value out of it. But that's kind of the number I've always shot for. Scott?
Just a quick question. What you paid for it or what Zillow says it is?
What you pay for it. I mean, Zillow, there's a lot of words we could talk about Zillow with. And I would also say too, a lot of the rents have changed as well from the perspective of being a landlord nowadays, where people are also renting. There's a cost or a rental amount you're earning per bedroom. So things are very much shifting in the real estate perspective, in the real estate space, at least from the real estate agents I work with, and determining how much you can generate from a rental property. We used to see that a lot in, say, the DU area or CU area when you're renting to college kids, right? You're renting per bedroom. That is shifting a lot to expand out to more rentals across the whole state.
Great point. Great point. Yes.
I just wanted to ask, we're in the age of, what do they call it, where you have a personal property, Airbnbs.
Airbnbs, right, the short term.
Will we be including any conversation for that type of thing?
I'm going to talk about it a little bit on the short-term rental side. So the question's on the short-term rental side. There are some, depending on how much time and work you personally put in, or do you hire out a management company, there are some benefits to that tax-wise, depending on how much time you are involved in putting into that property. So we'll lightly hit on that piece of it. Okay.
Yeah, the other thing to consider too with short-term rentals, it is county specific. So each county has rules and requirements of what they will allow and won't allow. For example, I'm pretty sure in Denver County or Jefferson County, a person, management, like a individual, can only own like 2 short-term rentals. There's very, very strict rules with this. So if there's something that you want to dig into further, start with the county that you're looking at purchasing in.
And they're changing. Sorry about that. I was just saying, and they're changing. So it used to be there was kind of no restrictions, right, in a lot of our mountain towns, and so people were purchasing mountain properties and renting them out. And what it has done is it has decreased the amount of properties for employees to live in up there. And so what they're doing is cutting back. So they're starting to grandfather people in and things like that. You have to have different permits and things like that. So it's just something, as Courtney said, it's very county specific and it's ever changing. So you want to make sure you get with the right people to make sure it's all, so you don't buy something and then go, great, now I can't rent it.
Yes.
So
Yeah.
Yeah, I was just going to add, well, even an entity that owns short-term rentals, once you get over 4, I think it is in Denver County, the property taxes go way up. They
Yes.
tax you as a commercial entity instead of an individual entity. And so you can do it, but it costs you a lot to do so.
Yep. One of the things I would really say with any of this, if you're in this business already of owning rental properties or looking to get into it, there's a lot to think about. There are a lot of landmines out there, and that's where professionals come, the meeting with professionals and talking through things beforehand. This is what I'm thinking about doing. What are the consequences of this? Tax-wise, expense-wise, everything. I would really give that a lot of thought as you head down that path, okay? Yes?
This is a quick housekeeping question. Are the slides available via the QR code for later?
They aren't right now, but I'm happy to make them available. So we can do that. Good question, Kareem. So we can do that. Yep. Okay. One thing I would always encourage you to do with this, if you get into this area, is to really treat this like a business. Use QuickBooks, a bookkeeper, track all of those expenses. If you get it audited, which if you set up a business on the side, when you get audited, you don't want to be trying to figure out what did I do 3 years ago? I don't know what I had for lunch yesterday, okay? So, make sure that you have this figured out. Make sure you track all those expenses. You want to understand the return on your investment. I have a slide on that in a little bit. We'll talk about, there are different ways to calculate that. I'll give you a simple one tonight to talk about. Another big one is separate your bank account from personal. Don't commingle. Yes, please don't. This is a big one we see all the time. Don't commingle your personal account with your business account. Bless you. So have a separate account for your business for everything goes through that account, right? Don't underestimate costs. Again, this goes into the planning side, right? That, we've thought about everything. A big one that, you go buy a property and all of a sudden now you realize, oh, I didn't know that there was an HOA expense. And the HOA's expense is, $1,000 a month. That's not a good surprise, right? So make sure we understand that. Put everything in writing with your tenants. Verbal doesn't work, right?
Agreed.
Yes, okay. Have proper insurance coverage. We're going to talk a little bit about that as we go through extra things you can do like an umbrella policy and so forth. So anything additional on that end?
I would just say on all of this, when you have rental properties, one thing that we always talk to our clients about is liability, okay? So if you have a rental property and somebody gets hurt on that property, they are going to go after the owner of that property. And so when it's you as an individual, that opens up all your personal assets to be a part of that lawsuit if that lawsuit exceeds the amount of your insurance coverage. So one of the things we do with our clients with rental properties is we will put them in LLCs and things like that. And so part of what we had up there and why the separate bank account is so important is that it allows us, people I'm sure have heard the term piercing the corporate veil, right? If we have our accounts kept separately, if it's in a separate LLC, it's titled separately, it's very difficult to get to your personal assets. But if you take the rent check that comes in every month and you put it into your personal bank account, there's a very good argument that this wasn't actually a business, that this just went into your personal account. And then in terms of the writing everything down, write everything down with your tenant. If you say it, put it in an email, screenshot text messages, do whatever you need to do to make sure you have captured everything, because you will be amazed at what people will say you said, even if you didn't say it. And also if you have business partners. A lot of times people are like, oh, we bought this property together. Put it all in writing, and put it in writing when you like each other, because that is when we're fair to one another. When we don't like each other is when we won't be the most fair we can be. So
Yes. Yes. Yeah. Please do that. Even if it's your best friend. Okay.
Your spouse.
Yes. Yes. I promise. Okay. Yes, sir.
Can putting a rental property, transferring ownership into an LLC cause problems with an existing mortgage?
It depends.
It depends, and so that's actually a piece right here on financing. Yes.
Do you want me to jump into that?
You've got that one, Courtney.
You got it. So Fannie Mae and Freddie Mac are the conventional mortgage lenders, right? They write all the conventional mortgage loans across the U.S. They do not close loans in the name of an LLC.
Correct.
So technically, if you change the title of your home, that mortgage entity has the right to call that mortgage due.
Yep.
However, in everyday practice, and this is where the attorney can get involved, in everyday practice, people change the title of their homes all the time. For example, if you have a trust and you want to put that property into the name of the trust, you're then technically changing the title of that property. So from the perspective of everyday practice, everyone does it. From the perspective of putting a mortgage in the name of an LLC, you cannot if you're getting a conventional mortgage. Now, you could go private financing and put it into the name of an LLC, but that obviously those terms and those mortgages aren't typically as favorable, which is why everyone wants to go Fannie Freddie.
I was thinking more in terms of an existing mortgage.
Yeah. Yeah. So, I would definitely I'm sure there's language that you can speak of as being an attorney from the perspective of changing the title, but it actually also has to deal with the title policy that is issued on your property. So your title policy that when you buy a property, you obtain, the seller will pay for and purchase a title policy for you. They are insuring the title. Right? So there are types of deeds that you can file that will not jeopardize that title policy, and there's types of deeds you can file with the county that could. So again, that's where you really want to make sure you're using an attorney to file the correct deed type to not jeopardize that title policy.
And a lot of what we do is, to Courtney's point, I have a lot of clients who own rental properties, and so we'll have them call their mortgage broker. What would happen if I did this? And a lot of times the mortgage company will say, if you've had it for a year, per our rules, you can transfer it to an LLC, right? So it just depends on what, there it is. I was like, how many times will I say it depends? As a lawyer, I just say it all the time. But it'll just depend on what the mortgage company will allow you to do. When you transfer things into a trust, so long as it's a revocable trust, that will never call your note. There's a thing, there was an act in place that basically allows, the mortgage companies are not allowed to call your note if you transfer it in, even if a person has passed or something like that. And it allows you to keep paying the mortgage even after the original owner has passed. So there's a bunch of different things that kind of come into play.
Thanks.
Yeah.
Quick item on here, Stephanie. I was going to see if you could speak to it, or any of you, but as to, okay, so we have a primary residence, okay? Putting that into a trust, it's something that my wife and I have done.
Yep.
Okay. Can you speak to that? What's the benefit or the purpose of that?
Sure.
Okay.
So in Colorado, when we own real property, we own it in our name, right? And then when we pass away, the reason we have to go through probate in Colorado when we own real property. So there's two reasons you go through probate in Colorado. You own real property or you have over $74,000 in probatable assets. And the reason we have to go through probate is because when the last owner of the property dies, if somebody just signs and sells that, we call that forgery, and we can't do that. So we need permission, which is probate process. It's the court permission to give somebody, your personal representative or your executor, permission to sign to sell the property or do whatever they are supposed to do with it. What a trust does is we retitle the home from your personal name into the name of the trust. So the trust is now the owner of that property. So on your primary residence, the reason we do that is so that when whoever the owner is passes, if it's owned by the trust, the successor trustee just steps in and follows what you want to have happen to that property. They don't have to go through the court. So it avoids that probate process, because we don't need court permission. We've already given permission who will be the signer on that. So that's how you avoid it. And so that's why we do that with your primary residence. And then kind of why we don't do it sometimes with rental properties and things is it's that bringing it back into your personal stuff. We want to keep it separate. So that's why we look at different entities to hold those properties and things like that.
Last on here, and we'll move on to the next slide, is umbrella policy. That's an additional policy that you can get fairly inexpensively to help, just provide another layer of protection on your properties and so forth. I would always encourage that, even if you don't own a rental property, if you just have a primary residence, I would have an umbrella policy. Eventually, if you do set up an LLC, you get to the point of, if you have an S corporation simply tells the IRS how you're taxed, right? And so it helps to avoid the self-employment tax, right? Because you can K1 and so forth. If you want to spend a half a second on that piece of it, so we get to the
as an S corporation, you're supposed to pay yourself a reasonable salary.
correct.
And anything that you earn above that amount is not going to be taxed as self-employment income. So you don't get taxed. You don't pay the self-employment tax, which can save you basically 15.4% on everything above that.
Yep.
I will say one thing for real property. A lot of times it's not put into an S corp because it's hard to get it out.
Yep.
With a partnership, you can distribute the property to individuals, and there's no tax consequences. In an S corp, if it's in there, it's hard to get it out without having a taxable
Yep.
situation. So.
Yep. All right, jumping ahead. So what is tax deductible? What is and isn't? Because who loves April 15th, right? Try to deduct everything, right? So, all right. So, Chris and Laura, if you want to speak to any of this, but I listed some items up there that may be tax deductible depending on what you have going on, home office, utilities, mortgage, all that, HOA. And we'll talk about depreciation here in just a second. But maybe any stories or anything funny that you've seen someone try to deduct in the past, or anything you want to throw into that?
Probably have a lot of stories.
Yeah.
I mean, if you're operating it like a business, you can take reasonable business expenses. Home office with a real estate, just a rental, that might be a hard sell, because usually home office is basically you're using a portion of your home exclusively and regularly to conduct business, maybe meet with clients. If you're owning real estate, you may or may not be doing that. We do a lot of home offices for other businesses, but I'm not sure that would be one that would be applicable to a rental. But certainly mileage for sure. If the thing with mileage, if you're going to meet with tenants, do any kind of improvements, you can take mileage. I saw on your thing there was also like meals, maybe, but again,
yeah. I pulled it off just because
rental,
it's probably
but
not.
for sure the big one is depreciation.
Yeah.
That's where you're gonna,
Yep.
Any
realize.
type of home improvement?
I'm sorry?
Are any types of home improvements?
Any
Yeah.
types of home improvement?
So some are deductible, some need to be capitalized, and they'll be depreciated over time. So.
Yep. Depends on the improvement. So real quick on here, just a quick example of a depreciation schedule. So let's say we purchase a home for $500,000. The land value underneath the home, that is not depreciable, right? We cannot depreciate that. But the improvement value, so the structure, the house itself, the $400,000 in this case, that's depreciated over a 27.5-year period. So you take the $400,000 divided by 27.5, and we end up with the $14,000 there that you can depreciate each year. Now, going through this, talking through a little bit more. So if we've got a commercial property, it's on a different schedule. So let's say we buy $1 million property, the land value's $200,000, the building itself, the structure, $800,000, divide that by 39 years. Now we have the depreciation schedule. Taking this a little bit further. Now, not everyone qualifies to be able to take advantage of this schedule here, okay? So don't get excited about this one yet by seeing this, okay? You have to qualify as a real estate professional. You have to. There are some points on here, which we'll get into in just a moment. So a cost segregation analysis. This is where you have an engineer. You want a qualified person to come in and look at the property. You don't want to do this yourself, all right? You can't. But what would happen? Same home, say $500,000. So now we have the improvement value, $400,000. Well, what the segregation analysis does is it segregates out what your what the improvements were, which is what Chris was starting to hit on there. So let's say we have $75,000 of fixtures, carpet, cabinets, appliances, and so forth. That can be depreciated instead of 27.5 years. It can be depreciated over 5 years, so much faster, right? And then trees, fencing, lighting, there are improvements you can do outside of the property, right? 15 years. The structure is still depreciated there at the bottom at 27.5. So now what we've done is we've segregated this out. So instead of in the previous example where we showed 14,000, now we have a depreciation of 27,576 in the first year. Okay. Now, not everyone qualifies to be able to segregate out those different pieces. We'll talk about that lightly here in just a moment. Okay. Any questions or points on that? Yes, Dean.
If you have a rental property and say you replace the boiler for $5,000, does that now become, if you don't do a segregation study, does that become part of the capital depreciation of 27.5 years? Or can I depreciate
Generally,
that?
yes.
Yeah, HVAC equipment, roofs, things like that are part of the structure, and then they're 27.5 years.
Yep.
Yeah, windows, same thing.
Yep. So, yes.
I think you had another question.
That's okay.
You sure? Okay. All right. So depreciation. So what does when does a cost segregation make sense? Well, if you qualify as a real estate professional, which we'll define that here in just a moment, or if you also qualify for the short-term rental loophole. So this is when we're doing the short-term, right? Average of 7 days or less typically. So who should perform this study? You want a qualified engineer to come in and do that study. And I've seen or heard all kinds of different quotes on that, anywhere from $2,000, $3,000, $5,000 to have someone come in and do that. But if you do qualify for that, spending a couple $1,000s to get that done is generally, you're going to offset that expense pretty easily in there, and it's great to do.
Sure.
Okay. Any other points on that one?
Just,
Yes.
Just real briefly on the slide before that, you don't have to go back. But the 5 and 7 year property, you had it shown there, but that is eligible for bonus depreciation.
Yes.
Up until last year, you could take 100% of that the first year. It's ratcheting down over the next 5 years. It's 80% in 2023 and goes down by 20% the next 4 years. So.
Yeah, bonus depreciation is another one in there, but again, we could spend hours on all this.
Sure.
I'm glad you threw it in there, Chris, but yeah, it's a great one also to have in there. Jump forward here. Talking about a 1031 exchange for a moment. So what is a 1031 exchange? That allows the seller to postpone, not eliminate, postpone the taxes by exchanging for a like-kind property of equal or greater value. Did I get that one right?
Yep.
Yes. Okay. Eligibility requirements. So you cannot do this on your personal home, right? So if you have a trade, a business, or it's an investment property, so not personal, what's the time frame on it? So 45 days from the date of sale, or also you can exchange within 180 days.
Don't you have to have the
Well,
property
Sorry,
identified?
you have to
Identify.
identify
Yeah,
the
you
property.
have to identify
Sorry,
the
that's the part that I had off.
property within
Yep,
45
you have to
days.
identify the property
Yeah.
within 45 days.
Yes.
And then
That's
you have
it.
to close on the sale of the replacement
Within
property
180.
within
And-
180.
Yes.
Yep.
You've got qualified intermediary there, but before you sell it, you can't take possession of any of the cash.
Yes.
So you have to know that you're going to do this before you sell. You can't decide after you've sold, oh, I've identified a property now, because
Yep.
that's too late.
Yeah.
So
Correct. So you need to work with a qualified intermediary, which is a person or a company that works to sell your property, purchase the property, and transfer the deed to you. So exactly what Chris said. Do not take possession of during that sale. Yes.
When you say like-minded property, is there a difference between residential and commercial?
No.
No, there is not. Just real property used in a traded business or held for investment. It can't be short-term rentals typically won't qualify because
Right.
they're I forget the term, but that, and then like if you hold not investment, but like lots for sale as a dealer.
A business, yeah.
Yeah, that doesn't qualify either. But if you hold land for investment, you just expect it to go up over time, that qualifies.
Yeah.
Yep.
So you could sell raw land that you held for a while and use that to purchase the kind
Commercial building.
Commercial building
Mhm.
or, yeah.
There's
or
quite a bit of
residential.
flexibility
Yeah.
in there.
There
There is.
used to be like-kind exchanges that involved personal property as well, and you couldn't do personal property for real or vice versa. But as long, they've done away with the personal property issue, so now it's really all real property in the U.S. can be exchanged for each other, or all real property outside the U.S. can be exchanged for each other, but you can't do domestic for foreign or vice versa.
And
Yep.
one more clarification, you said we equal one property. Can you sell one big property and buy four?
Sure.
Yes.
Yep.
Yes.
Yep. Or vice versa, or
Mhm.
you can have 8 into 7 or something like that.
Yep.
I've seen it.
And on the mortgage side of things, I work with folks all the time that are utilizing the 1031 exchange. And so from our side of things, the mortgage itself is not in the name of an LLC. As we know, we can't put a conventional loan into the name of an LLC, but we can filter it through the 1031, and that is part of the mortgage process as well. So land title, I'm not sure if land title is an excellent intermediary
Yep.
that we use often. And there's a gentleman over there that I'm good friends with that if you guys have further in-depth questions about the 1031, we can certainly get you in touch with him. Yeah.
Yeah, yeah, you can reach out to us and do that. This area here, this is very, very light. What we are hitting on here on the 1031 exchange, there can be a lot behind it. So, but again, identify the property within 45 days, sell. We need to close within 180 days after, right?
Yep.
Okay. All right. Types of real estate investors. So now this, we can spend a lot of time on this. We're going to hit this lightly, okay? Because there are a lot of different paths on this, a lot of rules, but passive investor. So that one's simple. Do you have a pulse, right? Okay. And I'll give you a real quick example of a passive investor. A lot of you have heard of REITs. You know, if you buy a REIT, right, you're not involved in that REIT in any way. You just own that and someone else is managing and controlling that and so forth. That's an example of a passive investor, okay? An active investor, so this is where you're making most of the general decisions. You're doing you're approving tenants, rental terms, you're approving expenses. You're fully engaged in the process. Rental losses can offset other income. There are limits though, in terms of there's a phase out and so forth, and up to $150,000 there, where those passive losses you can't. They move forward to following years on your tax return. Anything else to add?
They're suspended, basically.
Suspended,
If
correctly.
your AGI is above 150,
Yep.
it phases out in between 100 and 150 for most people.
That's right.
I was going to say something else. Oh, you were asking about funny stories. So if someone came in and said, I'm active, and then I saw that they gave me management fees that they're paying, that's kind of taking you out. You know what I'm saying? Just like what Kyle said, if you're paying a management fee, you're not making the decision. Somebody else is really managing the property. So,
Yep.
yeah.
Can you please use the microphone? There's a lot of background noise.
Oh,
sorry, yes.
So,
Back and it's-
yeah. The microphone is, sorry, on that also, it's for our recording. We don't have any other audio. So yeah, we'll just try to speak up.
Okay.
Yeah, thanks, Kareem. Yeah, sorry, we were supposed to have this whole room, but yeah. Plan B, right? Okay. Yep, all right, so on here, next is real estate professional. So real estate professional, this is, from a tax perspective, there are a ton of benefits here. This is a great area to be able to qualify for. Not everyone does. So it's based on your hours of time. There's primarily a two-part test, which is, are you spending more than 50% of your time, your personal services were performed on that real estate, and at least and another part here is greater than 750 hours in real estate for the year. I'll give you a quick example. Let's say that I were a fireman and I work 3 days a week at the fire department, and my other 4 days a week I spend in real estate. Well, those 3 days, let's say that those are 3 12-hour days. Well, the IRS is going to look at that as I'm more than, if we're looking at a 40-hour work week, those 36 hours I put in, those are eating up more than 50% of the allotted 40 hours during the week. I'm not going to be able to qualify. No matter how much time I spend outside of that job, I'm not going to qualify as a real estate professional. Okay? Am I correct on anything else to add?
Yeah.
Just on that piece of it?
Yeah, I think, at least 50% has to be
At least
spent.
50% according to the IRS.
And 750 hours.
Yeah, 750
Which is
hours.
hard to get to if you're
Right.
working full-time.
Yeah.
Yes. But that allows you, if you do qualify, now we can go in and do that cost segregation study that we talked about a moment ago, where we can deduct more than just the structure of the property. We can accelerate those other areas to deduct or accelerate that depreciation faster, right? Which can be a great benefit, right? So this is a big one here. Again, with all of this, there are a lot of landmines out there where you want to make sure that you don't step on any, that we're not filing one way, but come to find out you didn't have the hours that the IRS requires, and now we have a tax problem because we deducted things that we shouldn't have deducted. So that's where talking with professionals to make sure that we're going down the right path really makes sense, right? This one's fun. So I think this should help a lot in terms of you have a lot of different types of income. You have passive income from real estate potentially. We have capital losses, capital gains losses. We have ordinary income. We have a lot of different types of income that we can make or losses in those different areas. And one of the mistakes I see often is, I mean, just on paper, if we're trying to keep things really simple, but the IRS, I mean, how thick is the IRS tax code? I mean, it's taller than me if we stack it up, right? So you can't commingle all of your income, losses, gains, and so forth. You can't throw it into a blender and make a smoothie out of it, right? Everything is separated out, and those go on to different forms within your tax return, right? Your capital gains in one area, income and so forth on other forms and so forth. It all has to be separated out, and it's all so that the IRS can see what's going on. You want to add more to my smoothie there? Did I muddy the waters?
Yeah. No, it's very complicated, and every situation's unique.
It
so
depends.
It depends.
It depends.
it depends.
It depends.
That's it.
And if you qualify as a real estate professional, you can blend some of those together. Some of those cross over. So it just depends what you qualify for and what you don't qualify for. Okay? All right. Again, so this is something one-on-one to talk with probably a tax professional about what's going to qualify and what's not going to qualify, and are things going to get pushed forward further down the road into future years. Okay. Cash on cash return. There are a lot of different ways, I think, formulas to figure out. Like in commercial real estate, cap rate is a great formula to use. I kept this one simple up here, just a cash on cash return. I think there are a lot of formulas you can use to determine, what kind of rate of return am I making on this property. So up here, what we're going to use is just cash on cash as a simple example. So what's my net income after all expenses? So what I mean by that is looking at, all right, so I've got my rent, I take out my mortgage, any other expenses that I've had on that property, and I'm not in this, on your cash on cash return, you're not figuring in your expenses yet. Am I writing off my cell phone or, whatever it is that I've got going on there. So it's my net income on that property. So what's my net income before I take anything really as an owner out of there, any income and so forth? What is that property producing for me, and what did I pay into it? What was my down payment? What were the improvements? So I put $110,000 in. I'm going to divide that by the $8,000 of net income I have for the year. That would be a 7.2% rate of return on that particular property for that year, right? Very simple. It's a very simple formula to use to see what your cash on cash return is. What am I making based on the cash that I put into the property? What am I getting back out? Okay? All right, very simple one. Right. Passing properties on to beneficiaries, and I think as we go through this piece also, if you want to sell one of your properties or sell multiple properties, or maybe a lot of clients that I talk with, they've had rental properties over the years, but you get to a point where maybe you're near retirement or you're in retirement and you decide, I don't want to manage these anymore. I don't want to be involved in this anymore. I want to eliminate that headache and get rid of that. So what are some options? We're going to talk through some things here. There are more options than what we've put up here, but just want to hit on some of the popular items and talk through this a little bit. And Stephanie, you probably have some things you can throw in here just in terms of documentation, bank accounts. I think one thing on there that I would always throw in is always name a beneficiary on your personal and business bank accounts. If not, we can end up going through probate,
That's
right?
a probatable asset.
Yes, it's a probatable asset. So, always name those beneficiaries. That's a big one on bank accounts. Yes, Kareem.
Unless they're in a trust.
Correct, because it's titled,
Titled as
yep.
the trust.
They're
As
already
the trust.
already titled.
Yep.
Yep.
And
You've
if you have
already
a trust, you can name the beneficiary of the bank account to be the trust, so it pours it in afterwards. Yep.
Yes, yes. Anything else you want to throw in there?
On this
Before-
slide?
Yes.
Oh, yeah.
Oh yeah.
No.
Go for it. Go for it. I'm gonna get into opportunity zones and a few things, but please jump
Okay.
in. I know this
I'll
is your
just kinda
wheelhouse.
Start just with proper documentation. So there's a number of ways when you pass to pass property. The one thing I will tell you not to do, please don't put your children on your property and be like, that way we'll hold it as joint tenants, and when I pass away, it'll just pass to them. That way we don't have to go through probate. That is a terrible idea. Please don't do it. And the reason I say that is for a number of reasons. One, and we'll talk about it in a little bit, but step up in basis. When you do that and you pass it as joint tenancy to your children, you're going to lose part of that step up in basis. So you're basically agreeing to pay taxes when you wouldn't otherwise need to. We don't like to do that. So the other reason don't put your children on this is it's now an asset of your children. So when they get divorced, their spouse gets to say, well, I'm entitled to half of that property, even though that was not ever the intention, or creditors and things like that. So just don't ever put your child on there. There's other ways to pass it to them. You can put it in a trust and pass through there. You can put it in an LLC, assign the LLC interest to the trust, and they can go through there. You can do it as a will and go through probate. Probate's not terrible in Colorado. There are things in Colorado called beneficiary deeds, where you file them. And they basically, you name who gets the property when you pass. Beneficiary deeds can be good. They also can be very risky. In that, in Colorado, when you file a beneficiary deed, the person who is receiving that property has 4 months to file the death certificate. And if they do not, it kicks it back into probate. And there was a case that came out, which I won't bore you all with, but somebody forgot to tell the insurance company that somebody passed away, there was a fire, and now there was no coverage. So there's a lot of little things you have to watch. So we really limit beneficiary deeds, but there's a number of different ways to document how you will pass it. And I just always tell my clients, I know sometimes it seems like a simple way to do it, like X, Y, or Z way, but generally if it doesn't cost you very much up front, it'll cost you a lot at the end, and generally through taxes or having to undo a lot of the work that you unintentionally did.
Great. Yes. Please don't ever put that in. Don't add your kids.
Yes.
Yes. Yeah. See that all the time. All right. I'm going to hit on opportunity zones for a minute. How many of you are familiar with opportunity zones, or heard about it in the last few years? No, yeah, kind of. So I'm always very, very careful about them. If you ever look at one, if you sell a business or you've got a stock, if you ever have an appreciated asset, you can move that money into an opportunity zone, which can help with the step up in basis. There's some tax benefits, and if you leave the money there, over a 10-year period, you can receive a full step up in basis and eliminate the tax on that. And but I would be very careful and definitely do your research on the opportunity zone. Okay, be very careful about that. We have vetted a few. I think there are a couple out there that we really like that I think we can present to you if that opportunity comes up and we're looking for one. I'll give you an example of something that you might be able to do there. We've got one of them well, I'll jump in. I'm going to jump ahead to the REIT here in a second. That's actually what I was thinking of. On the opportunity zone, there are different parts here, and if I've got this right, if you put let's say I have a property that it has a low cost basis, $500,000, it's appreciated to $1 million. I roll it into the opportunity zone, so I don't have to pay the tax there when I roll it in. If I leave it in for a 5-year period, I can use 10% of the step up from the cost basis. If I leave it in for 7 years, I get a 15% step up there. And if I leave it in for 10 years, then I get a full step up in the cost basis. That's been my...
I'm not
Do you know
sure.
if
I think you can you defer the gain for sure.
Yep.
And then you also can exclude income that is generated on your investment
Yep.
during the time it's in there. But I'm not sure on the step up part.
Yeah. But on the 10-year period though, we leave it in for 10 years, we get the full step up
Yeah.
on there.
Yeah, I don't know, and I don't know if
Is
that,
that-
includes the step up from the original, but like if you put a
That,
$1 million property in, so you had 500,000 gain, and then it went to 2 million in 10 years. I know the next million is
that is.
Right.
definitely gets a full step up, but I'm not sure about the first 500,000.
Okay. All right.
Honestly, I don't know.
Okay.
I haven't.
So we need to
We've only
clarify
dealt
on that.
with a
My
couple
understanding
things.
from
Yeah.
talking with another CPA at
Yeah,
I
you-
Bailey was that we get the full step up.
Yeah,
So
okay.
again, we all need to make sure we get, talk with the right professional to get all that figured out. I'll give you an example on the REIT here on selling properties. So, there are public REITs out there that you can invest into. There are private REITs. We've got a particular REIT that we've done, I think, a lot of research on. We feel really good about. I'll give you an example. Let's say we have, and we've had this pop up a couple times, where we have a client where they have multiple kids, and some of the kids, when they inherit those properties, some want to hang on to the properties, some want to get right out of the properties and get the cash out, right? And the ones that don't want to get out of the properties, they don't want to get hit with taxes oftentimes. And so you can look at different REITs out there where you can roll that money into the REIT, and now the kids own shares within that REIT, and the kids that want their money, they can sell and take that money out. They can sell their shares. The other ones can leave that money in there and let that continue to grow so that they don't get hit with the taxes at that point in time, therefore satisfying some of the kids. And the others, now the negative part of that is you have less control because it's going into a REIT, right? Versus maybe the properties that you owned as a family before, right? But what you're doing is you're avoiding the forced sale, the tax on that forced sale and so forth to make some of the kids whole, right? I'm going to hit on a charitable remainder trust here for a moment and talk through this. I'll give you, this is an example of what I'm hitting on the basics on this of what we did for one of our clients. So talking through this a little bit, one of our clients, she owned a dental practice here in Denver. She bought a building years ago down there in the lower left for $300,000, and it had appreciated over the years to $2 million. So now we've got the gain, the $1.7 million gain. Now she was ready to retire. She wanted to sell the building. And I had asked her, and her and her husband had saved up enough cash. They did not need the cash to retire, or they had saved up enough cash for retirement. They did not need to sell this building for retirement. Okay, so I had asked her, what do you want to do with the sale of the building? She said, well, I'd love to one day, not now, but one day give it to our 2 kids, the cash off the building. So I said, okay, well, if you sell the building to your partners, you're going to owe a tax on that, on the $1.7 million, which would be up there in the upper left, a $409,000 tax. Well, that got her attention real quick. She did not want to have to pay the capital gains tax on that. But there are many ways around this. This is one answer that worked for her. This doesn't work for everyone, right? So it depends on whether or not you want it. So we set up in the upper right a charitable remainder trust. So what we did is we donated the deed to the building to the trust, and then that transaction took place. Now, how much does a charity pay in taxes each year? 0, right? So now that transaction took place. Now her partners now own that building, and the $2 million from the sale of it went into the charitable remainder trust. So one day, whatever's left over inside that trust will go to the charities that she named. Now that charitable trust kicks off an income, 5% of the $2 million, which is about $100,000 a year. So now after taxes, we've got about $70,000 to work with because most of that is taxable. So now the $70,000, we took $30,000 of it and we set up one more trust called an ILIT, a life insurance trust, which we named her kids as beneficiaries. Now her kids, when all this took place, both her kids were in college. So again, she did not want to hand $2 million over to the kids, and she didn't want to pay the tax. So we set up the life insurance trust, named her 2 kids as beneficiaries. Now how much do you pay in taxes on a life insurance payout? Nothing, right? In most cases, right? It depends, right, Stephanie? Okay, it depends, okay? In most cases. So the kids will inherit that in their particular case. They'll probably inherit that $2 million tax-free, but there's $40,000 left over that they can go Ashley and her husband can go spend that money on anything that they want. And because they donated that to a charity, they also received additional tax benefits. Her husband kept working for a few more years. He was able to apply that against his income, saved an additional $500,000 in tax savings. So collectively, about $900,000 in tax savings, and $2 million to go tax-free to the kids one day. Okay? Depends on your situation and what you're looking for and what we're trying to do. There potentially are answers out there to reduce taxes or eliminate taxes, whatever it may be. All right? This is the way I look at it is, if you looked at a menu at a restaurant, I like most things on menus. I like good food, right? But I don't like everything, right? This is a menu item. This may be something you like. It may be something that you don't like, right? Or something that doesn't fit with your situation. But this is just an example of what you might be able to do depending on what we're trying to accomplish, right? Anything else to add there?
I was just say this is a perfect example of why you need a team.
Yes.
Right? So the estate planning attorney, talking with the CPA, talking with your financial advisor, right? All of these things play in so that you can get the best advice possible for your situation, because I don't know everything about everything. I know enough to be dangerous. And so I like to make sure that we have a good team so that what I draft, make sure that it has the best tax savings and it's in compliance with the goals that you financially want to do, and it's to benefit your family. So this is a perfect example of why we need a team, but this is it's a wonderful tool.
Yep.
Yeah, and it, just to throw in there, it's important that you do this before you go through a transaction. A lot of times so many times we get somebody come in, it's like, well, I just sold a building, how can I avoid tax on it? It's like,
Too late.
it's too late at that point. You got to do
Do you have a DeLorean? I mean, we got a problem. Yeah. It's not going to work. Not going to work. That's a great one. I mean, I can't emphasize that enough, Chris. I mean, so often clients come in and say, I just gave money to my kids because I wanted to give it to them.
Yeah.
Okay, well, we just lost step up or something. I mean,
Probably gift tax return.
right.
Yeah.
Yes. So please ask a professional before we make financial decisions, so that we don't shoot ourselves in the foot or paint ourselves into a corner where now we're forced to pay a tax or whatever it may be.
So in the example you just used, it was a commercial building. Is that same process available for like your primary home? Can you do it and do it charitable trust there?
So with primary homes, you get that step up in basis, so you may not want to utilize this. There are certain assets that can go into a charitable remainder trust. Not every asset can go in there, so it just depends on what the asset is. But so it just kind of depends. But commercial buildings, rental properties, things like that, where you're going to have a large gain, are really good places to utilize these.
Yep. All right. On here, so we've been talking about real estate a little bit. What also ties into that is all of our other investments in cash, because we need to take a full. I mean, I ask this question all the time. If you do this, please don't raise your hand. When April 15th comes around, do you ever write a check for a larger amount than what's due? No. Right? I mean, if you owe $500, you owe $10,000, you never make it out for a larger amount, right? Why would we give the IRS more than what's due, right? If we don't have a plan for our entire financial picture, looking at taking a holistic view on all this, we're probably going to pay unnecessary taxes, right? So what ties into all of that is this piece here that I'm going to hit on quickly, which is talking about IRAs and your 401ks and so forth. So this is an example. This is one of the things we put together for every client that we meet with, which is showing on the far left here, what would be your net value, your estate value in terms of just the pure cash that's going to get passed on to your kids and grandkids. One of the things that we create is we run two plans. We run your scenario, how will things play out if you keep doing what you're doing? And then if we provide some tax planning in there, how might that play out to increase that situation? And in this case, we see, we can see the hard numbers there. And this is running the exact same rate of return. We don't change the rate of return in between the two plans. So same rate of return, we have a nice step up there of $1.5 million in net value. But then on those qualified accounts, the IRAs and 401ks, when we run those numbers, think about this in your head for a second. How much do you have in all your IRAs and 401ks? whatever that amount is, over your lifetime, if you live a normal life expectancy, between you and your kids, you're probably going to pay about that amount to the IRS. You have $1 million in those accounts, that's about what the IRS is going to get out of those accounts. So how do we reduce that tax? Because you can spend your money better than, I don't care who's in Washington, right? You can spend it better, right? So how can we reduce that? So if we look at this, in this case, what are we going to pay in taxes? 2.1 million versus if we can reduce that, potentially in this case by a third, get that down to 1.4 million, that puts 720 grand less. I mean, think about that. Writing $720,000 of checks to the IRS, that's going to keep me up at night. That's a lot, right? And then the tax to your beneficiaries, if we can reduce that a lot. Now we definitely have clients that come in and say, Kyle, I don't care if my kids have to pay taxes or not. They still live in the basement. We paid for their kids, for the college, whatever. Stick them with the tax bill. I'm good with that, right? I mean, here, the way I look at it is it's your plan, it's your money. We're going to create a plan to fulfill your wish, right? But if you want to decrease that tax, we can do that. This is a cool one. Now, this over the years has only been available on the institutional side for families, literally. I mean, unless your net worth was significant, and I mean significant, 50 million, 100 million or more, this wasn't available. This is something we've just been able to provide and roll out to our clients this year. We've started doing this. This is really cool. So if you have, let's say if you've got cash, or maybe you sell those properties, and now you have cash, because typically most properties, most of the time, it's not in an IRA. Okay, so it's non-qualified money, it's cash. How do we get that to grow and keep our taxes down so we're not getting hammered with taxes on dividends and capital gains? How can we keep that down? So specifically, this is what's called direct indexing. Give an example here. We're not recommending this fund. This is an example of a fund that's been around for about 100 years. The blue line shows the gross rate of return on this fund is about 10%. Based on how a typical mutual fund is managed, and most mutual funds, they have to keep money in cash, and even if you have an IRA, there are internal taxes on a mutual fund that typically happen every November. So you take a mutual fund, let's say it holds 100 or 150 stocks, okay? When those mutual funds, a lot of times at the end of every year, they rebalance, they do some different things in there, they have to make a tax distribution. You, the shareholder, even if you didn't sell anything, you're paying tax. Anybody get I call it a love letter from the IRS, a 1099 every year, right? And you think, I didn't even sell anything and I'm getting a 1099, okay? Why is this happening? I'm going to do a video here in the next couple weeks on how this exactly works inside of a mutual fund. But when you figure out those taxes, that brings down that rate of return. This fund performed a gross rate of return of 10%, but because of the internal taxes on the fund, it reduced it by 3%, the rate of return. Now, when you understand compound interest over time, 3% over time, that's significant, right? So this page here is showing, let's say I've got a cost basis, that orange line going across the bottom, cost basis of $1 million. Hypothetical, let's say I bought $1 million of Apple stock years ago. Well, if at any time I want to sell that Apple stock, my cost basis is $1 million, so I have to pay taxes on any of the growth, right? So let's say it grows from $1 million up to, in this case, and this is over a long time period here, completely hypothetical on rate of return. But let's say it grows to $6.5 million. Well, I would owe taxes on that difference, $5.5 million, capital gains taxes. So what we do with this in direct indexing, too much to explain in here, but I'm going to give you try to give you a really simple example here. What did the stock market do today? I'm glad a lot of you don't watch. Now I know, Michael, you watch every hour on the hour, okay? But the stock market was down about 0.3% today, okay? Well, what we would ideally want to do in this case, what I would want after 25 years, instead of my cost basis being low, what if I could have really the same gain, but what if my cost basis was right up there next to my value? How do we accomplish that? So again, giving a really simple example here. What if today the market was down a little bit, but what if we had an algorithm, a trading formula, that what it did was if the market was down a little bit today and we want to chip away at some gains, let's say I own 100 stocks. If the market were down today, all 100 stocks are not going to be down. Some are going to be up, right? So what if we could sell a couple of those that are up a little bit to offset the market dropping today? Now I've washed out that gain, okay? What if we did that all the way up as we moved along? So that when I go to finally access or tap into this capital down the road during retirement or later down the road, that my cost basis is very close to my actual value, right? Even if you have an appreciated asset. One of our clients came to us, she hit a bigger than a grand slam. She bought Apple stock in the sometime in the 80s. Yes. She has like a $2.5 or $3 million capital gain on it. Great problem, right? All of you are like, I'll take that one, right? Okay. So, but with that, how do we chip away at that? So we can create a portfolio there to start chipping away at that. And she also needs to be diversified, right? I mean, Apple's a fantastic company, but doesn't mean we want 99% of our eggs in one basket, right? But we can start chipping away at that and not have the capital gain tax on an annual basis. We can chip away at that. So direct indexing, this is what Vanguard recently did a study, and what this should do is this should add an extra 2 to 3% net rate of return to your portfolio on a tax basis on an annual year, each year. That's fantastic, right? So I know typically we don't have everything in real estate, or maybe we sell that real estate. How are we going to reinvest that and not get nailed with taxes along the way? And this is how that comes in, okay? So a financial plan should look at all areas. What we focus on, I mean, I spent 10 years at Citibank and Smith Barney. My first 10 years in this industry, all we focused on, all we cared about was the portfolio at Smith Barney. Okay? We want to go beyond the portfolio. We want to deal with all these different areas, have a great team to work with so we don't step on any landmines, pay unnecessary taxes, or create a problem for our heirs, or just as a business that we're running, or so and so forth, right? We want to look at all this, the estate side, healthcare, everything in there. Now, we're going to run some more master classes here coming up. We don't have dates for these yet, but on tax management, some for small business owners, legacy and estate planning. Another one we're looking at is Social Security and Medicare. So we're going to be running some more of these classes down the road where we'll have maybe some of the same panelists or more panelists that, you know, if we get into Medicare and Social Security, anybody want to talk on that one? No, neither do I. Yeah, I know enough to be dangerous, but we need, you know. So looking forward to these classes down the road. Our office, if any of you haven't been there, we're right at Bellevue and Quebec. So we're just down the street here, just down the road, a few minutes down the street. In terms of getting wrapped up here, all of this falls under having a holistic plan. On that form that you have in front of you there, it has a QR code. If you'd like to schedule a quick phone call, 5-10 minute phone call with who you're initially going to talk with is Kyle Gherkin. He may have stepped out. Kyle Gherkin in our office. You'll set up a quick 5 or 10 minute phone call if you wish to figure out who might you want to talk with or need to talk with. Maybe you need to talk with a couple of us up here. Maybe you need to talk, you know, you've got some basic questions or some in-depth questions. Maybe you need to, just speak with one of us or maybe multiple. Whatever that may be, that QR code is attached to Kyle's calendar, and then he can, get you in contact with the right person, whomever you might need to talk with, okay? So we tried to make it really simple. If you do want to set up a time to come into our office to talk, you can also talk with Kyle. Where is Kyle at right now? He's just outside the door, okay. You can step outside and talk with one of our Kyles. We have multiple Kyles in our office, okay? Just grab one of us, we'll get you taken care of. But Kyle is right outside the door, and he can set up that time. He's got the calendar. Here's one of the things I would encourage you. Hopefully this was beneficial. I know we covered a lot tonight. What I would always say is don't stop here. One of the things I see often, I'll sit down with a family that, you need to, maybe you do your taxes on your own, but you need to start working with a tax professional. Don't just make it a to-do item, and it gets lost. Or oftentimes I'll, talk with them, a family needs to meet with an estate planner. That maybe you need to update your will because it was 20 years ago the last time you saw it. It needs to be dusted off. Don't let that sit. Let's get these things done.